before we dive into two new items, I should say that one of the events previewed last week is now due in the coming week. The Office for National Statistics published wage growth and job vacancy numbers on schedule on the 17th, but delayed the release of the latest unemployment data until the 24th, owing to difficulties collecting the necessary figures. Make of that what you will. Well, on Tuesday the 24th, watch out for the latest numbers, when the current consensus is for the unemployment rate to stay broadly flat at 4.3%. Now, on to the new stuff. And the main macroeconomic item of the week, even allowing for the delayed UK jobs data, will be the latest policy decision from the European Central Bank, and that's due on Thursday the 26th. At its meeting in September, the ECB increased its main refinancing rate by 0.25% to 4.5%, a level last seen in August 2001. The ECB has also started the process of quantitative tightening, or QT. That started at a run rate of €15 billion a month in March and has since been increased to €28 billion a month from July to May 2024. That faster pace should see the ECB's total asset holdings drop by more than €300 billion. No change is expected in QT at this meeting, but it could be a close call on interest rates. The ECB's Governing Council was divided last time, as officials weighed the risk of a resurgence in inflation against the danger of a recession. As I sit here, markets expect one more quarter point hike by the year end at the most, to 4.75%, and that's expected to be the high for this rate hiking cycle in the EU. Now, any comments on the future trajectory of interest rates will also be important, as that might help to set the tone for the US Federal Reserve and the Bank of England on the 1st and 2nd of November respectively. On the corporate front, the third quarter reporting season is in full flow in America. We have a very busy slate of quarterly, first half and full year results in the coming week here in the UK, with 11 FTSE 100 firms and a long list of mid and small caps due to update their shareholders. Names which may be worthy of particular note include the following, although some of these dates could yet be subject to change. Shanta Gold on Monday the 23rd of October, Bunzl, Anglo-American and Softcat on the 24th, Lloyds, Reckitt Benckiser, ASOS, Fresnillo and Ibstock on the 25th, Unilever, Standard Chartered, Renishaw, Hunting, Inchcape, Bloomsbury Publishing and C&C Group on the 26th, and NatWest and International Consolidated Airlines will round out the week and the month on Friday the 27th of October. But the company which could just cause the biggest fuss in the coming week is Barclays, the first of the big FTSE 100 banks to report. It's due to release its third quarter results on Tuesday the 24th of October. Now, the shares have traded in a very wide range over the past 12 months, but overall they've eked out a very modest gain, despite worries over the UK mortgage market, the British economy more widely, and also how the investment bank's been doing amid a dearth of real new flotation on merger and acquisition activity, at least so far as UK equities are concerned. Although, we must note that Barclays was one of the four lead investment banks that got its trotters into the fee trough for the ARM flotation on the New York Stock Exchange back in September. The headline number to watch is pre-tax profit, and analysts are penciling in £2 billion for the third quarter. That's basically flat against the second quarter of this year, and indeed the third quarter of 2022. Analysts will then look to four main drivers behind that headline figure to judge quality as well as quantity, and also help them prepare their forecast for the fourth quarter and beyond. The first is loan and deposit growth. Loan growth has slowed right down in the past few quarters in the face of higher interest rates. Deposits shrank year on year in the last quarter, the first such drop since Q4 2018. Whether this is a harbinger of consumers and corporates drawing down liquidity as times get tougher remains to be seen. The second figure is net interest margin. Higher interest rates, or at least wider credit spreads, would help Barclays here, and in the second quarter, the net interest margin at Barclays UK was 3.22%, almost 3/4 of a percentage point higher than the mid-2020 low of 2.48%. However, management has suggested that further improvements are unlikely from here, and has flagged an outcome for the whole of 2023 of around 3.15%. The third factor is loan provisions and asset impairments. They've started to creep up, albeit from historic lows. The second quarter's impairment charge for bad loans of £372 million represented a loan loss ratio of 0.37%, took the first half total to £886 million and 0.44%. Chief Executive C.S. Venkatakrishnan and Chief Financial Officer Anna Cross have guided to a loan loss ratio of around 0.5 to 0.6% for 2023 overall, so a further increase in loan losses and impairments is possible in the second half. Finally, analysts and investors will look to the investment bank. It made £2.9 billion pre-tax in the first half of 2023 against £2.5 billion in the equivalent period in the prior year, despite a drop in income. For the full year, analysts currently expect pre-tax income of £4.8 billion against £4.3 billion in 2022. Now, third quarter last year, the investment bank made £1.2 billion pre-tax, so that's the benchmark for this set of results. Barclays is unlikely to talk about dividends until the full year results in early 2024, although do note the bank continues to run a £750 million share buyback scheme, as announced alongside the second quarter, and that's to supplement the £500 million programme completed in the first half. That you and your families are all in good health and good spirits. I've got a bit of a cold, but nothing too serious. Thank you for watching, and I look forward to seeing you next time.